and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Inflation is moving in the right direction. We had this softer than expected headline CPI print. Core was in line with expectations. If you look at the underlying inflationary dynamics, they still point towards disinflation. It's a little bit slower than we had anticipated at the start of the year, but that momentum is still in place.
I think it's very much kind of a Goldilocks kick the can type of print for the Fed, but I think the retail sales, the softness we saw there, certainly a bit of relief for the Fed, and I think it's what markets wanted to see to kind of continue this very, very modest rally that we've seen over the last week.
The meme stock trades tend to only occur at extremes in sentiment, and so to me, this is yet another mood indicator that the markets are reaching a point where we should expect some sort of a meaningful pullback, because if we look at the relationship between stocks like GameStop and the broader markets, this coincidental euphoria seems to be repeating over and over.
We have got 1 hour to go until the market close, so let's take a look at the major averages sponsored by Tasty Trade. We are on track for a record close for some of the major averages, at least. Right now, the Dow is not among them. It's up about 272 points, about 2/3%, as we did get that consumer price index measuring inflation coming in a little bit better, a little bit cooler than expected today. So we are seeing still some hope springing eternal that we'll get a rate cut this year. The S&P 500 is on track for a record close today. It's up by 1%. The number to beat there is 52.54. We're well above it right now. And in fact, we got a street high target for the year end for the S&P 500 today from Brian Belsky over at BMO. He's looking for 5,600 by year end. And then the Nasdaq is also on track for a record close. Any gain today, in fact, would be a record close because it closed at a record yesterday. So that index is up 1.3%. All of this as we see a pretty significant pullback in yields today on the back of that CPI report, down 8 basis points right now to about 4.36%. How is that being expressed amongst the different groups in the S&P 500? It is not an entirely broad rally, right? We are seeing some groups in the red, including energy and materials, but very slightly in the red. It is tech, real estate, utilities, healthcare that are helping lead the gains. And then the gains. And then since we were just talking about meme stocks, wanted to get a quick check on that. And I'm going to equal weight it here so we get a better look at what is up and down. So many more stocks down today, including the likes of GameStop, which is now pulling back by 22%. Although if you look at the 3-day chart here, you still see a pretty big gain. We're going to delve once again into the breach, if you will. Once again, we'll be talking about meme stocks later in the show, Josh.
That's right, Julie. Stocks moving higher today. The S&P 500, Nasdaq in record territory. It's after a soft reading on inflation. The consumer price index rising 0.3% in April over the previous month and 3.4% from a year ago. We also saw retail sales coming in flat as the consumer showing signs of slowing last month. Joining us now to break it all down, we've got Jose Torres, Interactive Brokers Senior Economist, as well as Edward Jones, Senior Investment Strategist, Angelo Kirkifas. Jose, let's start with you here. And we'll start, Jose, with that CPI print. What did you make of it, Jose? And importantly, what do you think Jay Powell made of it?
Thanks for having me, Josh. Well, I think that it was a cool reading and the market's loving it. I think the Fed is liking it too, but an important consideration is that most components actually inflected higher. We really got bailed out by new and used automobiles within this print. Now, the good news is that commodity prices are down big this month, and we're probably going to get the first favorable inflation report for the year next month. However, from January through April so far, every single inflation print has been quite above the Fed's annualized 2% target. And the standard there is roughly 17 bips month over month. I'm concerned that services disinflation hasn't occurred all of last year or this year. I think goods and commodities are starting to work their way lower, but services remain the problem.
So if services remain the problem, then, Angelo, and as I mentioned, we are seeing the market start to still price in maybe some interest rate cuts by the end of the year? You know, obviously that number has been swinging quite a lot as we've gotten each new economic data point. But do you think it's likely given this latest information?
Yes, we think 1 to 2 rate cuts are realistic. I think today was the combo of Fed-friendly data, looking at both the CPI and retail sales, that validate the Fed's stance of not considering further rate hikes from here, but signaling patience. Although the market, the number didn't deviate very much from expectations, I think markets are breathing a sigh of relief that disinflation continues. The trend remains lower, even though we are walking down a bumpy path, if you will.
Jose, let me bring you back in here because Angelo did mention retail sales. I want your take on that as well. April retail sales unchanged, weaker than consensus. The team at Pantheon Economics, Jose, saying this was, in their words, a clear signal of weakening consumption. Is that how you saw it, Jose?
Well, Josh, since 2022, we've seen consumer spending in some months really fall off a cliff, only to recover quite strongly. Consumer erraticness has been part of this cycle for the last 2.5 years, roughly. So I'm not ready to call the consumer quits just yet. They might come back quite strongly the next month. However, savings are really depleted. Sentiment is down. Consumers are not only concerned over higher prices and lofty interest rates, they're also now fearing their job stability as well. So I do think that there's elevated caution that's warranted this time around. However, we have to remember the consumer, as the chart there shows, that we've seen these declines in previous months, particularly last December, only to see the consumer rebound really strong. Finally, GDP in the fourth quarter to the first quarter of this year really slowed down significantly, down to 1.6%. Now, if the consumer doesn't pick up steam this month or next, and inflation keeps rising, then we could be in a situation where we get a negative GDP print for the second quarter, and that's what I'm concerned about.
Angelo, are you concerned about that at all? I mean, something else in addition to some of the consumer stuff that Jose was just talking about, I was looking at those household debt figures that we got earlier this week from the New York Fed, showing a record high in household debt, credit card debt ticking up, right? So is that another sign that the consumer might be on a little bit of delicate footing here?
I think if we learned something over the last couple of years is not to underestimate the U.S. consumer. No doubt, indicators point to a softening in consumption. And yes, we might have different paths for low to medium income consumers versus the high income consumers. But at the same time, we spent more than a decade with households deleveraging after the financial crisis. So the starting point is not one of weakness, but the incremental rate of change is likely softer. As this is happening, however, we are seeing other parts of the economy that were under pressure last year, for example, manufacturing and housing, are starting to stabilize and potentially recover. So we see the economic expansion continuing, not at the same pace as we have seen it, but that is likely welcomed by the Fed. We are in this interesting part of the interest rate cycle where good economic data or okay data might be better than great, because the market is interpreting that through the lens of what it means for the Fed.
Jose, another topic I want to get your 2 cents on. President Biden spoke with Yahoo Finance yesterday about these new tariffs on Chinese imports. Jose, just as an economist, I'm curious how you're thinking about that, what you think the potential impact is on the macro in terms of growth and inflation, Jose.
Absolutely, Josh. It was a great interview with Brian. I enjoyed it myself. But the problem is that that's one of the important factors that's driving inflation structurally higher, is the shift from globalization to regionalization. Today, the top importer for the United States happens to be Mexico, no longer China. Whether President Biden becomes reelected or his predecessor wins the election in November, I think that the rhetoric and the actions towards the Chinese will remain quite tense. And that's going to keep inflation higher a few basis points overall, and make the path down to 2% for the Fed particularly troublesome from the good side. And like my fellow panelists just mentioned, we are seeing this manufacturing recovery. We're seeing copper prices start to rally quite strongly, up to around close to $5. And that's really going to threaten the goods disinflation and the commodity disinflation that we really benefited from last year. However, geopolitical tensions are simmering, and that's quite positive for the disinflationary story.
So, Angelo, you might have heard me mention at the top of the show that we now have a street high target for the S&P 500, 5,600 from BMO Capital Markets. Given everything that we're talking about, is that realistic here that we continue? I mean, even if we see some bumpiness in between now and the end of the year, is it realistic to imagine we could get there?
Yeah, I think this rally is not built on sand. There's a good reason that the uptrend in equities continues. We have rising corporate profits. We have an economic expansion that continues and is not threatened at this point. And then we do have the potential for a major pivot in the Fed with more likely downside in yields than upside from here. And all that supports an ongoing bull market. But I do think that the opportunities might lie beneath the surface, meaning that over the last 12 months, gains have been concentrated in these mega cap technology companies. But we might see more broadening of market leadership. And over the last 3 months, we have started to see hints of that.
Guys, thank you so much. Really interesting stuff and perspective on the numbers today and where we go from here. Jose and Angelo, thank you. We're just getting started here on Market Domination. Coming up, GameStop and AMC are tanking today. We'll check in on the latest meme madness moves as the trend begins to fade. Plus, Cisco set to report earnings after the bell. We'll be joined by an analyst to break down those numbers once they cross. And it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned. More Market Domination after this.
Time now for some of the day's trending tickers. Looking at shares of NVIDIA, the stock getting a boost as KeyBank Capital Markets sees limited signs of a demand pause for that company. This comes ahead of NVIDIA's first quarter results next week. So NVIDIA's Q1 earnings, they are on deck May 22nd. And the previews from the street are coming in, Julie, including our man John Vinn from KeyBank out with a note, says he expects Q1 results and Q2 guidance to come in meaningfully above expectations. Sees that upside driven, he says, by improving supply of H100 GPUs. Lead times, he says, there have normalized, and strong demand, he says, for those China compliant chips as well.
Right, and one of the concerns, I guess, that's been raised is that ahead of the introduction of the Blackwell GPUs in the second half of the year, that there might be that demand pause as people are waiting for the product to come out. But as he says, there's all these other products that people are still buying and that are on back order, et cetera. The other thing that really stood out to me is he is looking out to 2025. And he says in 2025 that Blackwell and some of their other products could drive over $200 billion in data center revenues for next year. Now, just to put that in perspective, last year, those data center revenues were $47.5 billion.
Huge jump.
Therefore, that would represent a 321% gain in data center revenues alone. That's not the whole company's revenues from 2023 to 2025, if he is correct.
Yeah, and I think it dovetails with kind of his bottom line, Julie, where he says NVIDIA remains uniquely positioned to benefit from AI and machine learning data center growth within the industry. He says we see limited competitive risks. They may be trying other companies, but he doesn't see it. Expect NVIDIA to continue to dominate one of the fastest growing workloads in cloud and enterprise. We'll see.
Well, speaking of AI plays, that brings us perfectly to our next trending ticker, which is Dell. Not necessarily one you think of when you think AI and all the names we've talked about, but the stock is jumping to a record high. Morgan Stanley reiterating its buy rating on the stock and raising the price target to $152, which I believe is the highest on the street, in a note today, saying that this stock is the best way to play the AI server momentum. So that part of the game here, and Eric Woodring and his team over there talking about that they've been doing channel checks here on those AI servers, and they say that it shows Dell gaining momentum in enterprise infrastructure, which is interesting here. And they also say that there's an improving PC market that should help the company too.
They see a number of different tailwinds. So it is AI servers, talks about PC market as a tailwind as well. You know, this stock, Julie, has just enjoyed, as we talked about in the show, it is a remarkable run. It's up about 90% already this year. It's up about 220% over the past 12 months. So, I mean, investors have been looking ways to play the AI theme besides NVIDIA. They have found it in Dell. Despite that run, by the way, Morgan Stanley still says valuation looks attractive.
Yeah, and again, it's not one that I necessarily would have sprung to my mind, but obviously investors have been buying it, so
absolutely.
They've been playing on this.
Finally, Chinese electric car company NIO revealing the first vehicle in its newer, lower-priced brand. Meanwhile, JP Morgan lifts its rating on the stock. So that was the news today. NIO introduces its kind of new mass market EV. It's called Onvo, apparently delivered and launched in September is what we're looking for. The CEO, by the way, Julie, going right after Elon Musk and Tesla, telling reporters his new model here calls it longer, wider, roomier than the Model Y, but look for deliveries, I guess, starting as soon as September is what we're looking for.
So you know why the stock is down? I don't know. We don't know. We can't figure it out. Well, I did put in some emails to some analysts to try and figure out. Many of them who cover this stock are based in Asia, in East Asia, so we didn't get any answers to what is going on here. If you look at how this thing is going to be priced, the L60,
it's cheaper than the Y.
It's cheaper than the Model Y in China. So
you do wonder about margins. And Bloomberg did point out, by the way, NIO has had its challenges. Posted an annual loss last year, didn't actually meet its own sales target. Deliveries fell in the first 3 months of 2024. Now, we know, of course, China, this is a cutthroat market, intense competition, price cuts, on top of, obviously, broader trends. EV growth just is not what it was.
Yeah, and maybe there's concern that, especially when you look at the pricing here, maybe that's going to be another money-losing kind of proposition, perhaps.
All right, well, coming up, it's the latest edition of our series, Goodbye or Goodbye. We're going to take a deep dive into two stocks to help you make the best choices for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're examining the foundation of two giants in the home improvement sector. Joining me here to discuss, Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Good to see you again. Thanks for coming back to Goodbye or Goodbye.
Absolutely.
And we're talking about the home improvement retail market specifically here. And let's start with the stock that you like, one that we just heard from, and that is Home Depot. The shares have done pretty well over the past year or so. So let's get to the reasons why you like it. First of all, there's what you call their integrated retail strategy that they deployed after COVID. What does that entail and how's it helping them?
Well, what they really did is enhance their digital footprint. So it's increased a lot of web traffic from consumers, and the return on that investment is data. And so what that does is it allows Home Depot to actually capture more wallet share from consumers because they know more about what consumers are interested in. So that investment has proven to be very profitable, help them control costs and stay ahead of trends.
And then also perhaps it's helped them, if they're better understanding what customers need. One of the things that customers need is contractors to do the projects that they want to do and hopefully buy the stuff at Home Depot.
Precisely. So inventory management has been a critical part of their cost controls. And so knowing where consumers are trending and what projects are popular has helped them maintain better margins by having the right inventory in stock to complete projects. So also joining customers with contractors to get that work done has proven to be a very valuable strategy for the stock as well.
Yeah, and that kind of brings us to the third part of what you're looking at, which is the pro market, right? And that has been a really interesting growth driver for them.
It really has. And they've made a couple of key acquisitions recently where they actually now have access to very customizable finishing products, whether it's landscaping or interior design. They now have a wider selection of products that help contractors that not just get the nuts and bolts done, but also complete design. And that has increased margins and a backlog of projects now that shows durability in the earnings for the next couple of quarters.
A quick step backwards here as we're talking about Home Depot, and we're going to get to your other one in just a second. There's really only one other big one, so but we don't want to give away. You know, how does Home Depot and what's happening right now kind of fit in with what's going on in the housing market, right? Where we are seeing kind of a freeze in some areas because of where we're seeing rates.
Well, no question. I mean, a few years ago, a lot of people were able to refinance their mortgage at 3% or maybe even a little bit less. That's anchoring those homeowners to those properties. They're going to stay there a lot longer because they have such a low rate on their mortgage at this point. So they're looking to really spruce up, take advantage of some of the equity increases that they've had in that house, and then make it more livable or maybe even completely new because they know they're going to be there for a lot longer than they may have already originally planned.
So let's talk about the risk then potentially for Home Depot. And that's what we're seeing, some weakness creep into big ticket discretionary sales, durable goods, for example, fridges and stuff like that.
Yeah, absolutely. Appliances, TVs, things of that nature. And that has, crept in a little bit into Home Depot's life where they've seen a little bit slower sales in those big ticket discretionary areas. If that were to continue, then it could be a worrying trend for the stock over the next couple of quarters. Retail sales coming out this morning, flat, not bad, but you're definitely starting to see customers be a little bit more thrifty in what they're buying.
If there is an uptick in home sales, what does that mean for Home Depot?
I think it's good either way. As people buy properties, they want to tend to make them their own. And so you'll see, I think, a pretty level set in terms of orders and order flow, and Home Depot tends to benefit either way, even if there is greater turnover in the housing market.
Any position in Home Depot?
Yes, we have it in several different of our portfolios. ZECP, our ETF, it's one of the principal holdings in there because of the consistency of the set of returns that we see from this point going forward. Obviously, year to date, it's relatively flat, but what we're talking about is what are you buying now, and looking at the future price structures of this particular stock. Over the next 3 years, we see earnings growth in the mid-20s. We would expect the stock price to probably follow as well.
All right, so let's get to the flip side of that, and that is Lowe's for people who have not guessed. Of course, it's the big competitor here. Stock price looks pretty similar, but whereas that is a potential risk. Why is it this pullback in discretionary spend more of a risk for Lowe's?
Because it's already happening, and we'll see more in their earnings report next week when they come out. But we're already seeing in their sales estimate revisions, big ticket items are coming in much lower. So it's already a measurable change to the downside on Lowe's. And so we're seeing that change in behavior happen there, but it's been more durable to the good side for Home Depot.
Interesting. And then as we see all of that happen, high margin items in particular are taking a hit.
Yeah, absolutely. Those bigger appliances tend to carry a lot more profit per unit for them, but they're also having inventory control problems of their own, where their cost of inventory has not been as sharp as Home Depot's, and so they're losing margin even in some smaller items as well.
And you also pointed out to us that they've been spending on their garden center. What do we expect on the seasonal side with the sales of those kinds of items?
Yeah, so there's a bit of a lag because we had, really a late start to spring, and that has lagged sales from the garden center. There's been a big investment from Lowe's to make those garden centers larger with more options, and we're seeing a delayed start to the planting season as a result of weather patterns. Again, just an area of weakness on the balance sheet. Might not be durable or long-lasting, but it definitely is something that's showing up.
Yeah, here in the Northeast, it's raining like every weekend. I wish it would stop. Okay. And then there's also the debt position of Lowe's versus Home Depot.
Yeah, I mean, really what all this comes down to is if interest rates are going to be higher for longer, and they certainly are compared to what we were thinking early in the year with maybe as much as 4, 5, or 6 rate cuts, now only 1 or 2, the level of debt on the balance sheet for Lowe's has to now be serviced or repriced at a much higher interest rate. That's going to be an immediate headwind to their profitability going forward. So just puts them again down a peg immediately compared to the peer of Home Depot.
And then quickly, one thing that could go right for Home Depot is that you could see them benefiting from that contractor
Absolutely,
demand.
There's no question. Again, that same demand from homeowners to get projects done is benefiting Lowe's as well. And to be perfectly candid, some of the backlog of orders at Home Depot is benefiting Lowe's as well, where contractors are going, where they can actually still get first priority in terms of placement and getting jobs done. It's benefiting Lowe's as well.
And do you have any position in Lowe's or just smaller than in Home Depot?
We do not have a position in Lowe's.
Got it. All right, Brian, thank you. Let's summarize what you're telling folks here. You recommend buying Home Depot. It sees benefits from its integrated retail strategy, the ability to add on to margins, and making strides in capturing the professional contractor market. On the other side, you say avoid Lowe's because consumers are pulling back on larger discretionary items. That's hurting them more. The loss of sales in those high margin items is then hitting earnings, and it also has a bigger debt burden on its balance sheet than does Home Depot. Thanks so much for being here, Brian. Good to see you again.
Thank you.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
With mortgage rates averaging above 7%, home builder confidence taking a hit in May. The National Association of Home Builders noting that a lack of progress on inflation is a drag on builders' sentiment. Yahoo Finance's Danny Romero is here with more. Danny.
Josh, home builders are not feeling too great about the housing market right now, especially that mortgage rates have stayed above 7%. The index that tracks home builder confidence came in at 45 points. That's 6 points lower than April's figure the National Association of Home Builders reported. So what does this really mean? It really highlights that builders, it's been a difficult time for builders, especially that material costs have gone up. Labor costs have gone up. So that means that the price of homes also has gone up, and that is also squeezing and pinching some of these builders. Another thing to point out from this survey is really that 25% of builders reported that they have cut home prices to help boost sales. Another thing that 59% of builders reported that they also had to use some form of incentive to really move the marker there, especially when it came to moving inventory and sales. While this is really a pessimistic report, there is some signs that the housing cost is moderating. If we take a look at the April's inflation report that we got out this morning, shelter, the component of CPI on an annual basis, has come down to from its peak of 8.2% a year ago to 5.5% in April on an annual basis. So that's really the moderation in these results is really giving some optimism in the market that rate cuts could be happening sooner rather than later. And we're seeing home builder stocks really move a lot in that expectation. We like DR Horton is up about 5% right now, Josh.
Danny, is there any, so looking forward, what are you hearing in terms of whether we're going to continue to maybe see moderation in some of those shelter costs?
Yes, like one expert has told me, shelter disinflation is on track, Julie. And that is something that we have been consistently hearing that, yes, it's been a while since we've actually seen market rate rents actually reflect the inflation data. Of course, there's a lag, about a 6-month lag there. But these results that we did see this morning are really proving to show that it is softening, especially in the rent side of this CPI report and also on the owner's equivalent rent. Remember, that is the rent that a homeowner would pay for the same property. And that came in unchanged at 0.4% on a monthly basis. But that moderation is really encouraging right now. And like I said, shelter disinflation is on track. When we'll see that? Hopefully, some people are saying that we could see shelter bottom out as early as next year, Julie.
Danny, I'll take it. Thank you so much. Appreciate it. Campbell Soup and General Mills getting upgrades today over from Bernstein. They go from underperform to market perform. So why the move, Julie, to a hold? Not bullish, but I guess less pessimistic. Well, the analysts talk about volume improvements in the back half of the year. Also does highlight, no surprise, valuation. Says recent stock underperformance has led to 20-plus year low valuations for both companies. In other words, they look cheap. Her target on General Mills is 70, for Campbell Soup 46.
Yeah, and she talks about this inflection in the latter half of the year in volume growth specifically, because we've been having this whole debate over the past year about volume versus price. Many of these consumer staples companies had seen increases in overall sales because of price increases, not because they are moving more product out the door. And there's been a lot of waiting on the part of analysts and investors for that to happen. So it's interesting. Alexia Howard here says that is indeed going to start to happen. She says we're going to lap price declines in single ingredient food categories more associated with cooking from scratch. She says that all of that will lead to an improvement in stock performance in the second half.
So more positive. Not enough to go full bullish, but
no,
at least moving to the sidelines.
But not an underperform anymore. All right, Wolf Research downgrading SunPower from pure perform to underperform today. Those shares are down very sharply ahead of the close. Look at that, almost 29%. Well, SunPower has already had a number of challenges this year. And Steve Fleischman, the analyst, kind of sums them up here when he says no 10K, 10Q, earnings call, or CEO. The company basically has been sort of revising some of its accounting here. It's gone through rounds of historical financial restatements, he says, and they've negatively impacted historical gross margin and earnings. Still hasn't filed its 10K. It's delaying its 10Q. They announced that they were getting rid of their CEO, but they haven't yet announced a new CEO. So he's putting all of it together in that note.
Yeah, price target $2, says it is the most extreme example of the kind of meme stock resurgent among clean energy stocks, and challenges ahead. You pointed out some of them, Julie, but company could need more funding. Kind of also talks about an uncertain outlook for the market in California in general, says it has more exposure in that state than some of its rivals, and says recent earnings results across the space actually have only made investors more cautious and careful on the pace of sort of recovery here.
Yeah, California has recently been cutting the amount of payments that folks can collect from solar power, so it's hurt the market.
Yeah, for sure. Moving on, the meme stock rally already showing signs of fizzling out here. Shares of both GameStop and AMC coming under pressure after 2 days of big gains. And joining us now is Kevin Paffrath, financial analyst and YouTuber behind Meet Kevin. Kevin, always good to have you on the show. Let's just start right there. Ken, we were talking a lot, of course, this week, as a lot of people were, the meme stocks, GameStop, AMC, BlackBerry, kind of fizzling out today. But start there, Kevin. What'd you make of the moves we saw there?
Yeah, absolutely. First of all, it's incredible. It feels like we're back at the beginning of 2021, and I'm just waiting for Vlad from Robinhood to start coming out and making announcements again. It's wild. So it's quite entertaining. But one of the things to know is even back in 2021, we had these down days. We're really only on the third day of this momentum rally again. I like to replace the word meme stock with momentum stock. That's really what this is. The more momentum you get, the more they go up. It's not really a fundamental move, right? It's all in volume and how many people are into it. Now, these off days can oftentimes lead to violent new rallies. So we'll see. Usually what people are doing, and I just pulled mine up, is they're just making a list of the highest short interest, and then they're going down that and buying it. That seems to be the only fundamentals that are going into this, and it's really entertaining to watch.
Are you participating in it?
I participated in the there was this company Faraday
Yes.
Futures.
Yep.
So yesterday I was looking at it going, this is like a tiny little company, and it was up 300%. And usually what happens is the news coverage hits after the market closes, and then it goes up even more the next day. And so today it's up another 150%. I don't think I'm going to play it again for tomorrow, but when I have small little trades on the side that I want to have some entertainment with when it comes to the momentum stocks, that's what I do. But I go in knowing that if I'm going to lose 100% of my money on those, that's okay. In fact, we started this thing in the office where instead of betting each other $20, we make the other person buy a meme stock option. So that way, if it really rallies, it really upsets the person who lost the bet more.
Amazing. And by the way, Faraday Future happens to be the second highest trending ticker on Yahoo Finance. So obviously you are not alone in noticing that one and that it does continue to rally. And there's a whole crop of other sort of meme-ish names that still seem to be going up today, even though, you know, GameStop and AMC are down. When you talk about the sustainability of this, I mean, one other big difference between now and 2021, as we have talked about on the program, is that the volume in these names is much lower. You know, when you talked about how volume has to be there for it to keep going, it's definitely higher than it was, you know, a week ago or 2 weeks ago, but it's much, much lower than it was in 2021. So what does that tell us about whether this can keep going?
Yeah, that's definitely going to put some upside limit on where we can go. What we have to think about for January of 2021 is we came off basically 9 months of the stock market going straight up. And that was, you know, Larry Kudlow, we're going to have a V-shaped recovery. Jerome Powell's running the money printer. They're sending stimulus checks. People are taking their stimulus checks and throwing them into the momentum stocks. Today, wallets are tighter. We haven't seen stimulus in years. You're not going to for a while. Credit card rates are higher. Grocery prices are higher. The dollar menu is now $3 at McDonald's. It's a lot harder to come around extra cash, and less people are playing the stock market than they were after 2020's madness. That's for sure.
Kevin, I'm just interested, too, to get your take. And granted, asking you to speculate here, but I'm just curious. When you think about why people were kind of moving into these names, GameStop, AMC, BlackBerry, what do you think, Kevin, was sort of kind of motivating them? Do you think it was, listen, maybe it's just fun. It's entertainment. You get to play along with Dave Portnoy, or is it, is it greed? Is it anger at, Wall Street and the hedgies? Maybe it's all three, Kevin.
Yeah, I mean, to some extent, it's all of those. The biggest motivation is to make money, right? Everybody wants to go in and buy a 10-cent zero-day option or a weekly call option and have it turn into $5. And the one time that happens out of 20 trades just kind of keeps everybody coming back because it's sort of like playing the lottery. It's really fun. Of course, the argument that, hey, it's to get the shorts, or, hey, why are they halting the stock? I did a whole video breaking down why they halt the stocks, the limit up, limit down, and that. People don't generally care about the mechanics behind it. They just want to make money. And I don't blame that, because times are tough, and I'm all for it. So, hey, if folks can make money on the momentum, great. Just know once it really consistently bleeds, it does bleed. The good news is, companies like AMC, they're starting to issue shares. A couple days ago, AMC raised $250 million. That covers a quarter of their negative cash flow. So they basically got 3 months of free operating expenses to pay for their employees and their theaters. it's actually really good for the companies and a good opportunity for them to stabilize their balance sheets.
Or at least to buy themselves a little more time in the case of some of these guys, right, Kevin? You're talking about momentum. You're talking about when the momentum turns against you and there's bleeding and it tends to continue. Looking at a chart of Tesla right now, Kevin. Because when you talk about momentum stock, that's a momentum stock right there. Not usually called a meme stock, right? But it has some meme-ish characteristics. How you feeling about Tesla these days?
Boy, Tesla's been a tough one. I think the way I look at it is my rule of thumb this year is patience for 2024, hopefully hope and bullishness for 2025. The reason I say that is we're right in the midst of an election year, and that shouldn't have anything to do with Tesla. But at the same time as you're in an election year, you've got Elon on X. He's got a very sort of one-sided political point of view. He doesn't hide that. That upsets a lot of folks who are usually your EV supporters and climate change supporters. Elon kind of remarks, oh, why would climate change activists attack Giga Berlin in Germany? Well, because of his politics, right? So I'd like to get past not only the election, because then I think we're going to see politics cool a little bit from the Elon point of view, but we'll also have gotten past the shareholder vote. We'll have gotten past the robotaxi event. We'll see how much adoption we actually get for full self-driving, what the adoption rates are, and most importantly, how much cash are they actually going to have at the end of the year? I'm worried that they're going to have to do a pretty large fundraise, and that's why they're cutting 14 to 15% of the staff, firing the entire supercharger team. It feels rash, but I think it's because they have to, running a little low on cash. So hope for 2025, but patience for 2024 is my take.
Kevin, that's really interesting, the idea that Tesla needs to shore up the balance sheet. What do you think is the most likely way they would do that?
Oh, they just issue shares. Not only do they need the share price to stay up so that Elon doesn't get margin called on his loan secured by Tesla shares over at X, but they would just issue shares is my expectation. And the reason for that is, you look at the balance sheet, they've got payables of that well over $20 billion. They've got maybe $3 to $4 billion of free cash available. And what's remarkable is their free cash flow in the first quarter was negative $2.5 billion. Then Elon suggested they would spend $10 billion this year on AI for their FSD. And I'm thinking to myself, where's the money coming from? It's certainly not coming from increasing deliveries. Right. So that's why we're seeing the cuts right now. We're seeing the cuts on employees. We're seeing the cuts on expanding the business. For example, two big things that I really enjoyed about Tesla years ago was the idea that we were going to build custom batteries, the 4680s. Now, those are really just a hedge. That's a word they use. They only use them for the Cybertruck. Right. The Dojo software infrastructure they were building out, the server infrastructure, that's a, quote, long shot per Elon Musk. These were things that were really, really great and full of hope a couple of years ago that are now hedges and long shots. And I think, again, it's because they have to. They don't have the money to keep throwing into these. If they did, AI, Elon's AI play, would have hired Tesla to do a server stack build out. Tesla could pay for that if they had the extra cash, and they would get the contract as opposed to Oracle. So I think there's definitely a massive cash problem, and that's why I'm just saying patience this year. But I do love the company, I love the people, I love the cars, and full self-driving is amazing. So it pains me to say that.
Obviously, you spent a lot of time looking into and examining Tesla. Interesting stuff, an interesting perspective. Good to talk to you, Kevin. Thanks.
Thanks for having me.
Coming up, we're taking a look at the best ways to play the energy sector in today's investor playbook. Stay tuned, more market domination on the other side.
President Biden raising tariff rates on strategic sectors such as EVs and solar. The latest bid to keep China from undercutting U.S. companies is coming as the Biden administration has already catalyzed billions in business investments towards industries like clean energy. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. And joining us now here in studio to discuss is Tyler Rosenlicht, Cohen and Steers Portfolio Manager for Global Listed Infrastructure, along with Mahip Mandaloy Mizuho, America's Director of Clean Energy Equity Research. Guys, welcome to the show, both of you.
Thank you.
Thanks, and Tyler, maybe I'll start with you. President Biden spoke with Yahoo Finance yesterday, talked us through sort of the reasons behind these new tariffs on China. I'm interested, Tyler, just get your general big picture thoughts on those new tariffs and what does it mean, Tyler, for the sectors, the companies you cover?
Yeah, well, thanks for having me. I guess, we think the tariffs themselves are important, but it's more the symbology and the symbolism of what they mean. We think the global demand for energy is going to rise a lot in the next few decades. There's a voracious appetite to satisfy demand needs from urbanization, from the rising middle class globally, from AI, data centers, and so forth. And now people are realizing to satisfy this demand, we need to be able to produce a lot of energy. We need to produce traditional forms of energy, and we need to make sure we have all the tools in place to satisfy growth in solar and wind and so forth. And so for us, it's about, we don't want to rely on trade partners that we don't trust or that we don't necessarily feel confident that we'll be able to get what we need into the future. So let's make sure that we support our domestic industry. We need all the energy we can possibly muster, and let's make sure we have the manufacturing base and the resource base to satisfy that demand growth, because there's huge objectives with AI and so forth, and we need to make sure that we can power it all.
Mahip, I want to ask you specifically about the solar industry when it comes to these tariffs. Is it too little too late in terms of giving a leg up to the domestic solar industry? Because they've already been undercut by cheaper Chinese solar panels.
Absolutely, that's a great question. And I think the Section 301, which Biden administration announced, that's probably more directed towards China. We already have 50, 70, 80% tariffs on Chinese solar products. So I think most of the companies have moved to Southeast Asia. And what some of the domestic manufacturers have done, they have petitioned to impose tariffs on Southeast Asian imports now. So I think any imports definitely any tariffs definitely help sustain the domestic manufacturing industry. It's been almost 2 years since we had the Inflation Reduction Act. We saw a lot of announcements of new capacity being added over here. We haven't seen them fully built yet. And part of the reason is all this oversupply. So we definitely need some of these.
Well, and many of the stocks have done terribly.
Right.
What has been, I mean, if they're getting this leg up, what's been going on?
No, so that's a great question. And I would say we can probably separate the companies who already had manufacturing capacity here, who did not have any China content. So First Solar is a good example. They have done phenomenally well in the last 2 years. The rest of the space has somewhat got delayed, I guess, in the sense that all the IRA benefits haven't yet trickled down into actual legalese from the Treasury. There was a delay in understanding those the law which was written within a few weeks. So that's an issue. And then you have higher interest rates and some supply chain issues, which has been impacting the industry.
And Tyler, I want to bring you back in and answer that same kind of big picture question, that question of, you think about these new tariffs, too little, too late. How do you think about that?
I think the reality is a lot of people have talked about this energy transition and they've said, hey, we're going to get rid of old forms of energy and replace it with new. And we think we're in this energy addition world, and we're going to need to rely on traditional forms of energy for a really long time. They provide great baseload power. We have the infrastructure in place. And it's going to be a huge growth opportunity to build solar, build alternatives, build wind, build nuclear, but it's going to take a really long time. And so maybe the starting point is a little bit late, but this is not like a 2 or a 3 year thing. We are talking about energy demands into the next few decades. And maybe our starting point is a little behind where we want to be, but let's get ourselves there and let's make sure that we have the domestic capabilities to do so.
Tyler, it sounds like you've been talking to some of the oil companies, because I went to CERAWeek this year, which is the big oil and gas conference, and that has been their line, which is sort of a new sort of fight back line from them, that we're going to need those traditional energy sources for quite some time.
Yeah, I'll just give you some very high-level numbers, which to us we think are really interesting. So if you assume that energy demand globally increases about 1% a year for the next 20 years, which we think is very realistic, and you just displace half of current coal consumption, you need to generate 45,000 terawatt hours of new energy in the next 20 years. So again, some new demand and reduced coal. That is the equivalent of the entire global crude oil industry today. So in the next 20 years, just to get to this world that we're laying out of energy transition by market share, we need to recreate the entire energy industry, the oil industry that's been here for over 100 years. So the magnitude of demand growth is huge, and the desire to make it clean is great, but we will need to rely on traditional forms of energy for a really long time because the grid's unstable. We don't have infrastructure to satisfy a purely renewables grid today, and we're going to need to utilize it for a long time.
Mahip, let's give viewers some ways to invest with this theme. One name, Nextracker, I know you like. Explain to us, maybe, why is that name a buy here?
Sure. So Nextracker makes solar trackers. They basically put the panel on a tracker and it tracks the sun. It's as simple as that. But it is something which increases the production, and you can charge a premium for that technology. So as solar and renewables grow, I think these guys also grow with that. And on top of that, the tracker penetration rates has been pretty low internationally. In the US, almost 90% of projects have a tracker. Internationally, it's only 30%. So you have growth rate on top of that increased penetration. So you have a massive TAM opportunity for these guys. And then on top of that, the management team has done pretty well since they went public last year after the spin-off from Flex. They have pretty much beat all the expectations in every quarter since then, and even yesterday they did for the same thing for the last quarter. And so the street likes them for that reason. They have a lot of cash. They don't have any debt is less than 1x debt to EBITDA. So it's kind of like checks all the boxes for investors in this space who would want to stay away from rate exposure and want to look at.
And valuation still attractive, I'm assuming.
Valuation still attractive, absolutely.
Mahip, Tyler, thank you guys both for joining today. Appreciate it.
Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell as markets are eyeing record highs here. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. We are joined by Jared Blick, ready to get you up to speed on the action from today's session, sponsored by Tasty Trade. Guess what? Market domination is a pretty apt name today because all three major averages are closing at records. We've got the Dow ticking up by 350 points, about 0.9%. The S&P up by about 1.2%. The Nasdaq up 1.4%. A lot of it has to do with the economic data that we got this morning. The CPI coming in a little bit lighter than had been estimated. Retail sales bang on flat here. So that raised some hopes that indeed we are going to see the disinflationary trend reassert itself in the coming months, that we will not see consumer demand be so hot that it's going to continue to push up prices at a re-accelerated pace. What does that mean for the Federal Reserve? Well, maybe it actually means that we'll get a cut or two before the end of the year, perhaps. And now all of that is pushing the 10-year down as well. Yields down to 4.36%, one of the major components of the rally in stocks today. Jared's got a closer look at today's action.
Thank you, Julie. Rate cut hopes, they spring eternal. I think that's really the bottom line. You nailed it. Here's tech. XLK up on top, up over 200% or 2% there. Nasdaq 100, very tech heavy, record closing high. XLK2, throw in financials. And last time I looked a couple minutes ago, it was going to be industrials too. So everything just kind of playing a game of catch up here. And as you can see, also all sectors in the green today. And then when we look at our leaders, Bitcoin came roaring back, starting at that 8:30 a.m. release. Was it CPI? Was it retail sales? Well, Bitcoin is up 7%. After that, we have chip stocks, then software, then the momentum trade. So lots of juicy leaders at the top there. What did not work well today? Well, XRT is a retail ETF, so a couple of retail names holding that back. Oil also didn't fare so well, cannabis and solar. But I'm going to be taking a deeper dive into the close today, the day that was, and the meme stocks in just a few minutes. Josh.
Thank you, Jared. It was a record day on Wall Street with the Dow and S&P 500 closing at new highs for the first time since March. Nasdaq also extending its record run. And Josh Schaefer is here with the takeaways from the trading day. Joshua.
Record highs. That's it, right?
That's it? You're done?
I think we're done. But no, we got record highs for all three major indexes, right? And Julie was just hitting on this a moment ago, but I think largely the rallies seem to be driven by the economic data that we got this morning. You had inflation, core CPI, finally coming back down. We had been waiting for that to sort of restart coming back down after the first 3 months of the year. And then you had retail sales coming in flat, and largely the fear had been, well, is the economy maybe growing too much? Is the consumer too strong? And that's what's keeping inflation sticky. And it seemed like we got maybe a little bit of fodder on the side of that narrative that, okay, maybe we're just all right. The market moved to pricing in 2 Fed rate cuts this year for the first time in a month. You had the 10-year down, I think about 10 basis points at one point today, again to its lowest level in about a month. So when you think about the headwinds we talked about during the April drawdown and your rising 10-year, right? The market's pricing out cuts this year. Are we even going to cut this year? Well, in the last month, we've sort of reversed that conversation. When you add that up, it kind of makes sense that the market's rallying.
It makes sense. It doesn't feel like I said woohoo at the beginning of this. It doesn't have that feeling, though, for some reason. It doesn't feel like this is this huge, momentous push upward like some of the previous rallies that we have seen, perhaps.
Well, because maybe it's only on one inflation print, right? And I think a lot of economists that we've been speaking with today have said they, like the Fed, they still want to see a little bit more data, right? And I think also you could look at the retail sales print, and economists sort of spun that with, okay, maybe we had this big tick up in March. There was also an Amazon sale that apparently impacted non-store retailers pretty significantly in March. So then when you don't have an Amazon sale in April, that's why that declined. So maybe the decline isn't that bad. But there is a world where retail sales flat month over month isn't the best sign.
Right. Of course. That's a normal world.
I think maybe that's why you feel a little bit of pause, though, right? We need to see a little bit more before we get too overexcited that, okay, yay, soft landing, fully back on.
Well, listen, Wall Street's, Brian Belsky's getting more bullish.
5,600.
Which, 5,600, as someone pointed out to me, is only 15% gain on the year.
Sure.
Why does he feel it? What was his reasons? Is it just he's in the decent economy, decent earnings are good enough camp? or he sees something else?
Yeah, so this is, I should highlight exactly who we're talking about here, right? We're talking about BMO Capital Markets Chief Investment Strategist Brian Belsky came out today, updated his S&P 500 year-end target to 5,600 from 5,100. Now, this is the first time Belsky's moved his target yet this year. We've been talking a lot about these strategists moving. This has been his first move, and Belsky normally sort of labeled as bullish on the street, so coming out with the highest target here. But what he highlighted, Josh, that was interesting to me, he talked about being comfortable with the fact that market momentum is kind of here to stay and trying not to avoid that this time around. He was referencing 2021 and 2023 and the rallies that we saw, and basically not being willing to just admit that the market momentum is moving in a way that could get us to 5,600. And then he actually used a lot of historical analysis in here. He does feel good about earnings. I know you asked about that. Belsky usually feels good about earnings. But he also used a little bit of a historical analysis in here. And Julia, you were just talking about this, that we'd only get to a 15% gain for the year. But what he was referencing is how much we've rallied to this point. And when you rally for the first 5 months at about an 8% clip, normally from May to December, stocks do particularly well. They gain, he got to 5,600 using a 7% gain from where we were yesterday. And over 70% of the time, if we have the first 5 months like we just had, that is what happens. So essentially saying that strength will sort of beget strength to some extent. The one caveat I should add, he still thinks we could get a larger pull down than we've seen thus far this year.
So that would be a time to pile in, he's saying.
Maybe so, right? But him sort of warning that drawdown that we had in April isn't normally the biggest drawdown you'd see in a year.
Did he break out, Josh, with this note, did he break out, if he pops the hood, what sectors he likes?
Not particularly in this note. It wasn't full sector by sector sort of going through exactly how he's getting there. But it will be interesting to see sort of how maybe the rotation plays.
Sorry, I'm interrupting you because I want to get in this last point.
Yes.
Mag 7 is still going up.
Mag 7 is still going up. Mag 7 is at an all-time high as well. So I was looking at the MAGS index, which is the round-tail ETF that tracks the Magnificent Seven. And I just thought it was interesting as we're talking about all-time highs across all three indexes. We haven't really talked about the Mag 7 a lot over the last month. We've been talking about the individual stocks and the fact they're doing better, right? And also interesting within that is kind of the rotation. We were writing earlier in the year about how it was Amazon that was doing better and Meta was doing better and Nvidia is doing better. Well, you look over the last month, it's Apple, it's Alphabet, and of course it's still Nvidia.
Yeah.
But setting the stage a little bit, maybe heading into Nvidia earnings next week.
May 22nd. If you've been watching, you know it's May 22nd. We've been talking about it a lot. Thanks, Josh. Well, one of the top trending tickers all day on Yahoo Finance, New Holdings. It's the parent company of the Brazilian digital bank Nubank. That's new as in N-U, not N-E-W. And the company reported record revenue in the first quarter. Joining us now is David Velez, Nubank CEO. David, it's great to see you again. Thanks for being here.
Hi, Julie. Thank you for the invite.
So you guys are big in Brazil. That's your home market. And what's remarkable to me is the growth that you guys have been seeing in Mexico. You're branching out into Mexico and Colombia. But in Mexico in particular, your growth has been fairly extraordinary. And I know some of it has been offering depositors their higher rates on their deposits. But talk me through your strategy in Mexico.
Sure. So Mexico is a phenomenal opportunity because we have a large market that is very low access to financial services. You have 12% credit card penetration. You have over 80 million people that have no bank account. It's a very much an informal economy. And we get the opportunity to come into this market, compete fully digitally by offering better yields and better products to the unbanked population. So we've been competing pretty significantly, gaining share across all the different verticals and becoming one of the largest issuers in just a few years.
And David, as I mentioned, one of the reasons you've been doing that is offering folks yields to get them from unbanked to banked in some cases, or to take market share from your competitors. But that's coming at a cost to you all, obviously, offering attractive interest rates. Right now, you're gaining scale there. When does it flip to sort of profitability in that market?
Sure, we're following actually the same playbook we used in Brazil. What it's interesting about Mexico is that when you look at the profit pool of banks, over 40% of the profits don't come actually from credit, they come from deposits. banks in Mexico pay effectively zero or very close to zero to their consumers. And so there is significant value to be created in offering higher yields. There is a lot of unit economics on the credit side. We are growing first with the credit, and even at offering higher yield, we're still making very significant unit economics. However, our goal is to have the very best deposit and savings account in the market. For that, we need high yield and a number of different functionalities. As we add new functionalities to our bank account, we're going to be able to decrease those yields while maintaining the value proposition. We did that in Brazil as we launched in 2014, where we launched a market with paying 100% of the risk-free rate. Eventually, we were able to decrease that yield while maintaining significant consumer activity and consumer base.
And David, I just want to get your take on one metric I saw here. I was reading, David, your Q1 did show an increase in delinquencies. Can you walk us, David, kind of just what's going on there and how are you navigating that?
Sure. So we just announced our Q1 result has been really record across all the different numbers. We were able to do about $443 million of net income. In Brazil, our core market, we had over 40% return on equity. So Nubank is very unique globally today in that it's the only digital bank in the world outside of Asia that has crossed the 100 million customer base while maintaining a very high satisfaction and very high profitability, higher profitability than incumbent banks. Specifically to your question on delinquency, what happens is Q1 tends to have a higher delinquency than Q4. There tends to be a bit of a hangover in the market because Q4 tends to be very high purchases. So we're seeing that seasonality go up. But at the same time, we're seeing a significant opportunity to expand in certain subsegments of the market. We're pricing risk effectively for that higher delinquency. And we ultimately, what we're trying to do is optimize NPV. We're not in the business of necessarily minimizing credit losses. If we wanted to do that, we just stop growing. We don't lend anything. We're in the business of pricing risk appropriately. And that's the opportunities that we're seeing in the market.
And finally, David, just on a note about Brazil specifically, I know there has been extensive flooding in the south of the country. That has basically immobilized the southern state centered in Porto Alegre. Is that having any effect on your business? Is that having an effect on, for example, borrowers' ability to repay? Are you going to see any effect on your default rate as a result of what's going on there?
Yeah, no, it's a phenomenal question. Unfortunately, this is probably the biggest tragedy we've seen in recent history in Brazil. Effectively, the entire state of Rio Grande do Sul has been flooded. About 5% of our customers live in Rio Grande do Sul, so our exposure is limited. However, we've been very forthcoming in trying to make it easy for our customers there. We've participated significantly in donations in the area, and we are extending and lengthening significantly payment terms for all the different consumers that we have. So I think it's not going to necessarily directly create significant impact for us, but from a consumer perspective, we think we got to be there helping our customers that are going through these very tough times.
Makes sense. David, thanks so much for being here. Really appreciate it.
Thank you so much, Julie. Pleasure to be here.
And now we got to get to Cisco numbers, which have just come out in the past few moments. The company is raising its full year forecast. So I want to get to that first. Revenue now seen at $53.6 to $53.8 billion. It had been $51.5 to $52.5 billion. So pretty significant increase in that forecast here. And if you look at the company's numbers that it reported looking backward at the last quarter, you see them there. The company beating by 6 cents a share on the bottom line. Revenue did fall year over year by 13%, but it did come in a little bit ahead of what analysts had been anticipating. And the Cisco shares are rising some 5% in after hours trading. The stock, by the way, is down almost 2% year to date going into these numbers here. I'm going to go through and take a look at the individual units as well to see what we're getting here. Networking revenue, it looks like ahead of estimates. Security revenue, $1.3 billion ahead of estimates. And collaboration revenue also, that one a little bit short of estimates. But networking is by far the largest part of the business here. The company has been integrating its acquisition of Splunk, and the former CEO of that company was named the president of go-to-market inside of Cisco here.
Yeah. I mean, heading into this print, as you noted, Julian, expectations were low. I mean, year to date, the stock had gone nowhere. It was actually edging lower, as you pointed out. I think plenty of questions for CEO Chuck Robbins about enterprise orders, about AI orders. You know, when does that start showing up as a real benefit to the company? Inventory levels, you know, are we close to getting kind of right sized there? And then to your point, Splunk and that acquisition, what is kind of Chuck Robbins saying in the call about any kind of potential kind of sales synergies between those two?
Yeah, and just one thing to point out from Scott Herron, the CFO, who made a comment in the statement saying customers are consuming the equipment shipped over the last few quarters in line with our expectations. He says we are seeing stabilization of demand as a result. And that is what people want. Well, ideally they want an uptick in demand.
Well, investors, you know, listen, for this thing, they'll take stabilization, right?
Looks that way.
Pop.
Right.
Coming up, analyst reaction to the Cisco report. It was a beat and raise from the networking giant, and the stock is rising on that news. Stay tuned, more market domination over time after this. Welcome back to Market Domination Overtime. Jared Blickery is standing by to get you up to speed on today's action, sponsored by Tasty Trade. Jared.
All right. Well, thank you, Josh. Let's take a look at some of these numbers behind me on the Wi-Fi Interactive. The Russell actually in second place, 1.2%. But I got to tell you, the theme of the day has been records. We had a record for the Dow and S&P 500, the first one since late March. And then the Nasdaq, well, that was the first one since yesterday. But lots of records to go around. If you take a look at the sectors, we have three there as well. That would be tech. That was its first in a while. Financials, also first in a while. And same for industrial. industrials there. And if we take a look at the leaders, we can see some of the fringe investments that we like to talk about have attracted money and some have not. Now, Bitcoin is in the lead. That raced higher after that 8:30 a.m. report this morning. Not consumer sentiment. I'm looking for CPI and also retail sales. Then chip stocks. Chip stocks had an amazing day. If you take a look at some of the record highs today, everything on your screen here is a record high. You have Broadcom, Qualcomm, Applied Materials, KLA, Microchip. The list goes on. And then you add to that Alphabet, JP Morgan. We're seeing, again, a broad swath of record highs. And so we're seeing this across industries here. Hopefully something that continues as we look for that. I'm going to send it back to you guys on that.
Thanks a lot, Jared. Appreciate it. Well, Cisco shares are rising in after-hours trading after delivering a beat on the top and bottom line. The company also lifted its full-year revenue guidance. Morningstar tech equity analyst William Kerwin is joining us now to talk us through this here. So we were kind of looking to Cisco as an indicator of corporate spending demand here. Just give us your sort of big picture takeaways, first of all.
Absolutely, and thank you for having me on. Really, Cisco's results came in roughly in line with our expectations across the board. As you mentioned before the break, networking really continues to be the primary driver of the business here. And Cisco has been talking for a few quarters now about slower spending at customers. We're digesting orders that ended up being a little bit excessive in the years following the COVID pandemic, really in 2022. And so we've been calling this a bit of a COVID hangover, if you will, for that networking demand. We think it'll come back in 2025, but probably another quarter or so here of that weakness. Now, on the positive side, Cisco did close on its acquisition of Splunk. That gave some upside to figures in the quarter. They got about half a quarter of contribution from Splunk. And we really see the full year guidance raise being wholly attributed to having Splunk in the door now. The guidance that they actually lowered last quarter excluded Splunk, so it fit with our expectations with Splunk now part of the portfolio.
William, let's say you're on this conference call coming up here and you have the chance to ask CEO Chuck Robbins a few questions. What would you ask him, William? What would be top of mind?
I think top of mind for us right now is, buying Splunk is great and getting that inorganic growth, but Cisco's organic security and observability businesses have been underperforming peers and the broader cybersecurity market for a few years now. So really the key that we're looking at in those businesses is now that they have Splunk in the portfolio, can they augment that organic growth rather than just continuing to buy assets?
And do you think they're going to be able to do that?
A little bit, maybe not as much as a lot of investors would like. We like Splunk standalone before being bought by Cisco. We think it's a really good fit for the portfolio. So we do model that organic growth coming more in line with the market, maybe not gaining share, but at least staving off those share losses.
And William, on this call, it's a good bet. Chuck Robbins is going to talk about AI and AI orders. Do you consider, William, as a financial analyst covering the company, do you consider Cisco a smart AI play for investors?
We think it has a good AI opportunity, but it pales in comparison to the size of the business, really. So we're expecting about $1 billion in AI sales for Cisco in fiscal 2025, which will start here in the second half of calendar 2024. And so that's a big number, but against a roughly $50 billion top line, we don't think it'll be a significant contributor to overall firm results in the medium term. We actually like, a networking peer like Arista Networks a lot better as an AI play, a little bit more highly concentrated in high-speed data center networking and better play on the AI trend for networking in our view.
The other thing that, with regard to Splunk that they mentioned is that the former CEO of that company is going to be the president of what they call go-to-market inside Cisco. Was that the right move to keep on Gary Steele and integrate him into that kind of a role?
Yes, we like keeping on Gary Steele, and we think, the title president of go-to-market makes a lot of sense. Again, talking about these, relative underperformers in security and observability for Cisco, we think go-to-market is really the key lever to pull there in terms of what to improve to get those back up towards growth more in line with peers.
William, it was great having you on the show today. Thanks for joining us.
Thank you.
Time now for What to Watch Thursday, May 16th. We're going to start off on the housing front. Lots of new data coming out, including housing starts and building permits in the morning. Economists expecting both of those numbers to go up. This coming after that home builder confidence report came in lower than expected and went down for the first time in 6 months. We'll also get new mortgage rate figures tomorrow afternoon.
Taking a look at earnings, it'll be a big day for retailers tomorrow. We're getting reports from Walmart and Ross stores. Walmart, of course, the world's biggest retailer, is set to announce first quarter earnings for fiscal year 2025 ahead of the opening bell.
And finally, we'll get a big round of commentary from Fed officials tomorrow. We'll hear from Richmond's Tom Barkin and New York Fed President John Williams, among others. And it comes after Minneapolis Fed President Neil Kashkari reiterating today that rates will have to stay at these levels for a while longer.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. We've got more Yahoo Finance on the other side.
It was a big day for Netflix, announcing a deal with the NFL to be the home of Christmas Day games for the next few seasons. But that's not the only news coming from the streaming giant. Yahoo Finance's Alexander Canal is here with some takeaways from today's Netflix upfront presentation, Allie.
Hey guys, yeah, so a lot of emphasis on the ad tier. The company revealing it's reached 40 million monthly active users, otherwise known as MAUs. The company had just 5 million users 1 year ago and 15 million users in November. So a significant jump there. The ads plan now accounts for over 40% of all Netflix signups in the markets where it's offered in. And it seems like the ad tier is also commanding some pretty high engagement levels. According to the streaming giant, over 70% of Netflix's ad-supported members watch more than 10 hours of programming a month, and that is 15 percentage points higher than the nearest competitor. Now, this wasn't the only news that we got from the upfronts. Netflix also announced a new in-house ad tech platform, which will give advertisers alternative ways to buy ads and measure impact. They're also continuing to leverage live events. Energy drink company Celsius is going to be the first presenting sponsor for the Jake Paul versus Mike Tyson event that's going to stream in July. There's also going to be other brand partners for this event that will be featured throughout the broadcast. So some more product placements for Netflix in the years ahead, potentially with these live events. Then, of course, you had some of the fun announcements, new content. There's a Happy Gilmore 2 with Adam Sandler coming to the platform. And then, of course, we got that NFL news earlier today. So lots coming for the streaming giant.
Lots coming. Upfront week. You're all over it.
week.
Thanks so much, Allie. Well, you can't spell Netflix without NFL. That's what Netflix said when announcing its new partnership with NFL to stream Christmas Day games for the next 3 years. For more, we're bringing in Citi Managing Director Jason Bazinet. Jason, it's good to see you here. Netflix had been sort of resistant to this whole sports streaming idea. Is it a good thing that they have come around?
Well, I think it is a good thing. I mean, it's natural. One of the concerns that we've had over the long period of time for Netflix is that it's very difficult to get scalability globally on content, right? You end up having to go into each individual market to tailor content to appeal to different folks. I think two ways to skin that cat is to go after sports, which does scale a little bit better globally. And then the other vector that Netflix is pursuing, of course, is video games, which is also, we think, scales globally more effectively than scripted content.
And Jason, any line of sight here or even estimates what you think the financial terms here might be, what they could be spending per game?
Well, I'll just give you some rough numbers. I mean, the NFL today in aggregate generates about $12 billion for their rights. That covers about 272 regular season games. So that comes out to about $45 million a game. Because these are in the Christmas period, you're going to get closer to the playoffs where the ratings are typically higher. So I would think something like, I don't know, 75 million, 100 million is probably the rough order of magnitude.
And then, you know, it's interesting, the announcement, because it's 2 Christmas Day games this year and then 2 holiday season games in the following years. I mean, could we even see a Netflix Thanksgiving Day game, for example?
Yeah, I mean, I think, look, now we started out where Netflix was against sports. And then when they did the deal to do the WWE, it was sports entertainment. And then on the last earnings call, they sort of opened the door to potentially doing sports. And so now they're just in the sports business. I mean, we can quibble and say, oh, it's only sports during the holiday season or whatever, but they're in sports. I mean, I think it's just the go forward business.
And Jason, we talk about this NFL deal, you know, and how it could help build out the ad tier. How do you think also it might just kind of support membership growth?
Yeah, I'm not sure. I mean, Netflix is so ubiquitous and the NFL is so popular. I'm not sure that the NFL is really integral to helping Netflix retain subs. I think this is much more about testing the waters, learning how to do advertising inside sports, and then sort of down the road, presumably bidding on more sports rights and doing more advertising. So I think it's a good thing. It's just a natural evolution of the business. But I don't think that this experiment with the NFL, I'll call it that, sort of small experiment, is going to do much in terms of retaining subs or making subs even more engaged.
This number that we got on the ad-supported users, the 40 million global monthly active users on the ad-supported tier, is that in line with what you expected, better than, worse than?
Yeah, the way we sort of look at this, I mean, Netflix gives us these MAU numbers, you know, every couple of months. And so we just subtract the time that elapses from the last time they gave us a MAU number to this time. And if you take that latest disclosure, it's about the same run rate that they were on the last data point they gave us, which was in December. So I would say this is no big deal, actually.
Gotcha. All right. Well, it's upfront week, not just for Netflix, but for all of the different networks, the streamers included, like a Netflix. Anything else that stood out to you? And I would ask on a broader picture, you know, do you have a favorite based on anything you heard or just in general in now what seems to be the era of bundling of these various streaming services?
Yeah, our preferred place is more to buy sort of sports. That's sort of where we're more animated. You know, Netflix itself, I mean, the bulls have been arguing for some time to put a 25 PE multiple on 25 earnings, which the bulls would argue is $25 a share, and they come up with $625. I look at that and I just sort of shrug my shoulders. I'm like, okay, let's say that they smash earnings and we get $25 of earnings, you know, a year and a half from now at a 25 multiple, you're playing for $625. It's just not that interesting to me. That's why we're neutral on Netflix.
Gotcha. Jason Bazinet, thank you so much. Good to see you.
Yeah, good to see you as well. Thanks.
Financial regulators testified before the House Financial Services Committee on financial oversight, and FDIC Chairman Martin Gruenberg took the hot seat amid a workplace behavior scandal. Let's get to Yahoo Finance's Jennifer Schonberger. Really, he has been coming under some pretty heavy fire.
Indeed, Julie. FDIC Chair Martin Gruenberg rebuffed bipartisan calls today to resign during a heated, nearly 4-hour hearing before the House over a third-party report revealing a toxic workplace riddled with widespread sexual harassment, bullying, and misconduct. Gruenberg accepted responsibility but refused to step down.
I take full responsibility. To anyone who has experienced sexual harassment, discrimination, or other misconduct at the FDIC, I again personally want to apologize and express how deeply sorry I am. I also acknowledge my own failures as chairman, both in failing to recognize how my temperament in meetings impacted others, and for not having identified the deeper cultural issues at the FDIC sooner.
Both Republicans and Democrats slammed Gruenberg for failing to rein in misconduct, repeatedly calling on him to resign. House Financial Services Committee Chair Patrick McHenry told Gruenberg he didn't think he's the right person to fix the toxic workplace culture at the FDIC.
You failed your employees, your agency, and the American people. The fact that you've not yet resigned proves that you take no responsibility for your actions, and the words that you've used so far also make it clear you take no responsibility for your actions. And let me be clear, showing up today is not an act of courage, it's an act of hubris.
Democratic Congressman Richie Torres asked Gruenberg if their roles were reversed, would he tell him to resign? To which Gruenberg said no. Meanwhile, Democratic Congressman Greg Meeks from New York said he was, quote, pissed off, noting that not a single violation of misconduct resulted in a removal or reduction in pay grade. Meeks said, quote, if it was me in my office, I'd probably be run out. Thursday, Gruenberg will face a second round of questioning, this time before the U.S. Senate, where Ranking Member Tim Scott has already called for his resignation. Guys?
Thank you, Jennifer. Appreciate it. President Joe Biden and former President Donald Trump both accepting an invitation to debate on CNN. Mark your calendars, June 27th. Here to talk with us about it is Yahoo Finance's Rick Newman. Rick, we've got a date for a debate.
I've cleared my schedule. I can't wait. Here are the three things I want to see. I want to see a push-up contest. I want to see both candidates take one of those cognitive tests we hear Trump talk about, where he has to answer questions, person, woman, man, camera, TV, or whatever. And I think they should each have to recite 5 tongue twisters.
I would watch that debate, but what are we actually going to get, Rick?
Well, I think we're probably going to get a lot of interest in this debate, even if it's sort of morbid interest. I mean, the jokes make themselves at this point. The grumpy old man meme is already dominating the internet. But I think what we actually would be watching for here. I mean, there probably are some voters who want to know what Trump would do in a second term or what Biden might do in a second term. But let's be honest. I think we're all of us who are going to tune in. We're all going to be looking for something that could become a viral moment that could turn this race one way or the other. Whether one of these candidates ends up doing something that looks foolish, scores a certain zinger, or does something else. I mean, everybody knows that age is an issue for both of these candidates. Biden a little bit older than Trump, but both of them pretty old. So it's really going to be kind of a contest to see, in one sense, who's the last man standing, and in another sense, who can have the least embarrassing performance, I guess, is the best way to put it.
Yeah, it's interesting, Rick, because I agree with you, there'll be interest. It's always just curious to me. I wonder if there's any kind of data or research showing that these debates actually have, they actually have impact. They actually matter. Do they, is there any evidence that they really kind of do influence and impact elections and how people vote? I don't know.
I mean, the famous example of this is the first televised debate going all the way back to 1960, when Jack Kennedy just looked more polished, more interesting, and more secure than Richard Nixon. So if you start there, sure they do. I mean, we keep talking about this, guys, but this election is going to be decided by a really small portion of swing voters in about 6 swing states. And believe it or not, there are some persuadable voters out there. So yes, I think these debates will potentially make a difference. I mean, the first one on June 27th, that's still pretty far ahead of the actual election date or when people are going to be casting their ballots. There is going to be a second one in September. So that one might turn out to be more important. And that's probably the only two we're going to have. Just as a reminder, we did have 2 debates between the same candidates in 2020. And I don't personally recall any viral moments that turn things one way or another from those debates. But this is a little bit different. Stakes are higher, and both guys are 4 years older.
That is true. Well, can't wait. Rick Newman, thanks a lot.
Come to my watch party.
Okay.
Yeah.
Stay tuned. More Yahoo Finance on the other side. Investopedia is out with its latest anxiety index. It's a gauge of investor sentiment based on the behavior of its readers. Here to help us dig into what investors are thinking, Caleb Silver, editor-in-chief of Investopedia. We know, like, consumer sentiment surveys lately have not been fantastic, but you guys, it doesn't seem like people on your side are feeling too terrible.
Yeah, they're feeling cautiously optimistic. We survey our readers actually every 2 months to see if they're bullish, bearish, what are they worried about, what are they concerned about, what would they do with an extra 10 grand. They're cautiously optimistic, right? But then when you get to actually putting money to work, we know April was one of the weakest months of inflows we've seen in several years. Some of that's tax season. Some of that is the fact that just investors weren't clear on which way things were going to go. Maybe there's a little bit more clarity now. We've had the jobs report, right? We've had this inflation report that's a little bit softer. But you don't see this retail emphasis like we did over the past couple of years, except for the meme stocks. But that is just a small piece of what's happening here. Retail trading is about 18% of the market now. Usually it's around 22, 25%.
What do you think explains that, Caleb?
I think it's not being able to see the future, right? When we can't see the future, it's like kryptonite for investors. So also we're coming off of some pretty good gains. Now we're back at record highs. But when we ask them, what do you think the market's going to do 6 months from now? The optimism in terms of returns over 5% was pretty limited. And I think these are experienced investors. These are DIY investors. They've been at this for a while. They've been through some cycles. And they know that after a great year like last year, you kind of get a good year, especially in this weird higher forever in terms of inflation and interest rates.
So is that what they're most worried about still?
Yeah, inflation's number one on their list of concerns, and that really has changed over the past couple of months. It was the presidential election, and I don't think that is about who's going to win and what does that mean for taxes. I think it means what chaos will ensue during this election season, because I think now we're prepared for it. So I think people were worried about that, but it's been inflation, and that kind of limits them. When you think about rising prices, and you're talking about the anxiety index, they're not anxious about their portfolios, and they shouldn't be. Are we not entertained with all-time highs? They're anxious about their personal finances, and that really tells you about the tale of two countries, the shareholders, the asset owners, and those that are just struggling to make ends meet. Sometimes those two don't line up very well.
And meme stocks was also pretty high up there. You mentioned that.
Yeah, meme stocks right now are cooking because Roaring Kitty, thank you for bringing everybody back to the party. So that's got our readers crawling all over Investopedia, trying to relearn what short
What did you, and Kayla, I mean, you've been studying the markets a long time. What did you make of what we saw? I mean, we were talking about a lot this week, along with GameStop, AMC, BlackBerry. What did you make of it? And what were the kind of similarities and differences you saw between now and 2021 frenzy?
Yeah, well, obviously things are very different because we don't have as many people participating, but you could feel it in this Reddit crowd and in the day trading crowd. It wasn't just the other day, right? Options have been building in these meme stocks for the past couple of weeks. GameStop has had a lot of momentum in the past couple of weeks before Roaring Kitty came out with that tweet. So it's kind of been building, and I think they need to do some to release here. Crypto traded off. That's their other favorite chew toy. So I think the meme stocks gave them a reason to get back involved. We love it when people get involved, but we don't like it when people try to catch falling knives. And I think there was some of that going on if you look at today's trade.
Yeah, although if people are just doing it for fun. I mean, we talked to one YouTuber earlier, Kevin Pathrath, who said, you have to understand if you're going to buy an option or do something with one of these stocks that you could lose all your money. So you sort of have to do it with your eyes open, I guess. I mean, what's notable to me, and we've been talking about the meme stocks a lot, as Josh mentioned, the differences between now and 2021. Among them, it's not the pandemic. People don't have stimulus checks. So are people just looking for kind of something different, something fun,
and you can't blame them.
Spice.
You can't blame them. But also, difference between now and 2021, higher interest rates, right?
Yeah.
Difference between now and back then. There wasn't any sports, or not a lot of sports, or not a lot of sports betting. We're in the midst of the playoffs right now. We've got golf tournaments happening. There's a ton of sports betting going on right now. And I think a lot of these people that like to day trade and play the options game and play the 0 days to even futures, I think a lot of them have the propensity for sports gambling as well. And so I think that's taken a lot of the money and the enthusiasm out by and large. But like I said before, when you get retail trading at only under 20% of market activity, you just know that it's kind of like a dull roar going on below the scenes here, and we're not getting that retail participation like we had in the past. That said, we got all-time highs again, and that's good in terms of the wealth effect and the way people feel about their money.
And you mentioned, so you're surveying your readers. Who are your readers? I mean, is it traders, investors, men, women, young, old?
And what income strata are we talking about as well?
Yeah, 8 to 80 or 18 to 80, I should say. White belt to black belt. So we have people who are just learning, and you can tell who they are by what they ask. But we also have some pretty advanced traders and investors that have been at this for a while. Average age around 45 years old, investable income north of $100,000. They've been through some market market cycles. So they know what happens when the Fed raises rates or when the Fed lowers rates. They know what happens when we have this market volatility that we had a couple of weeks ago, actually back in April. And I think that's why they were kind of staying away from it a little bit. But these are people that like putting their money to work. They are educated investors. They love it. But when there's no catalyst, they're happy to sit on their hands and just be passive investors.
All right, Caleb, thanks so much for joining us today. Appreciate it. And by the way, you can also catch Caleb on our podcast, Stocks in Translation, hosted by Yahoo Finance's very own Jared Blickery, tomorrow at 12 p.m. Eastern. Stay tuned, more Yahoo Finance on the other side. Walmart is gearing up to share another quarter of bulk size results. Yahoo Finance's Brooke DePalma is here with what to expect from the retail giant. Brooke.
Yeah, good afternoon. Well, the good times are expected to keep on rolling for Walmart here. They're expected to hold on to momentum in this quarterly results set to come out before Thursday at market open. Revenue is expected to increase 5% to $159.58 billion. That's on adjusted earnings per share of an increase of 7.25% to roughly 53 cents. Now, U.S. same-store sales are expected to see a slight jump. That does include Sam's Club here. Overall, U.S. same-store sales are expected to jump 3.42%, and that's expected to be boosted by an increase in foot traffic of roughly 3% to more consumers heading to Walmart, and a roughly 1.3% increase in ticket size. So ultimately, they're spending only a little bit more year over year. But there are four key things that I'm looking out for in this report. I want to know if Walmart continues continue to hold on to those grocery share gains that they made during the pandemic. I also am looking for more insight on the unveilment of its new private label brand, Better Goods, which is a higher quality, a bit of a higher cost as well. Also want to know more on that $9 billion store renovation announcement that they made last year, how those renovated stores are doing. And also, Walmart continues to invest in digital. U.S. e-commerce business is expected to see a 13.33% jump in sales. And also, they're really doubling down on retail media. The company is really looking to compete with Amazon when it comes to advertising. And so really interested to see what the results of this quarter was for Walmart Connect.
Interesting. All right, while we have you, on a different topic, let's talk about McDonald's.
Yes.
And the news about the $5 value.
This is this is very big in the Lipton household because, well, the 5-year-old, big Mickey D's fan.
All right,
what do I get for $5?
All right, well, here's what we know so far. So it's set to roll out on June 25th. We confirm with sources there for 1 month. And here's what you can expect from that $5 value meal: a McChicken or a McDouble. Alongside with that, you'll get a 4-piece chicken nugget, a small fry, and a small drink. Now, I do know, based upon sources that I've spoken to, is that this happened extremely fast. McDonald's introduced it. The franchisee operators voted very fast. And this just goes to show the position that they're in right now, that they want to boost or reignite those same-store sales here in the U.S. We do know that they missed expectations in this last quarterly result. Now, another incentive that made this value menu happen was that Coca-Cola, from what we understand, went in on this deal. We don't know the financial terms of the deal, but Coca-Cola did tell Yahoo Finance that we routinely partner with our customers on marketing programs to meet customer needs. This helps us grow our business together. So from what we understand, they also went in on this deal to help make it happen with some marketing funds. And then really, McDonald's using this as a promotion to really entice customers to get back. But also we know that it seems like everyone was all hands on deck to really reignite customers coming in and spending yet again at McDonald's.
All right, Brooke, thanks a lot. Appreciate it. Well, we're finally learning what was Berkshire Hathaway's mystery investment in the first quarter. Warren Buffett's company reporting a $6.7 billion stake in Chubb, the insurance company. It also announced it's eliminating its stake in HP. All of this coming to us via the 13F filings that companies like Berkshire, funds like Berkshire, are required to file to let us know what's going on here. So that $6.7 billion stake, insurance, not a new business for Warren Buffett.
Yeah, well, listen, greatest value investor of all time. So when Mr. Buffett makes moves, people tend to pay attention. HP is interesting. I mean, it's, the stock's done nothing this year over the past 12 months. Obviously, PCs, ink and toner. We have had analysts come on, Julie, on our show and talk about how maybe AI-enabled PCs, and you see that market get a lift. But Mr. Buffett is out.
Yeah, and those HP shares not down that much in after-hours trading. Okay, that does it for today's show. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.